This is question number 5 from the exercise of chapter 14. So let's read this question first. Apple.com is a young software company owned by two entrepreneurs. It currently needs to raise 400,000 to support its expansion plan. So their expansion plan is 400,000. Uh, A venture capitalist is prepared to provide the cash in return for 40% holding in the company under the plan for the investment. The venture capitalist will hold 10,000 shares. Shares to venture capitalist will be 10,000. Then their holding will be 40%. And the two entrepreneurs will have combined holding of 15,000 shares. So what are the two requirements? Number one requirement is what is the total after the money valuation of the firm? To calculate after the money valuation, you can simply say like you are giving 40% to the new venture. So this is the 40%. So remaining 60% will be around 6 lakh. So total will be 1 million. So this is one direct way because it's a simple questions, but this method will not always work. So you have to know the shortcut method to do any calculation. So for this purpose, we can just use this investment amount and divide it with the holding we are giving to the capitalist. So this will give us after post money valuation for this company. So this will be 1 million. Part B, what value is the venture capitalist placing on each share? So share price is total value, which is 400,000 divided by number of shares we are giving to the capitalist. So by dividing it, you will get $40. So venture capitalist is placing $40 to each share. Question number 6. Look at Marvin's first attempt to raise financing. Refer to the section 14.1 and the Marvin prospectus in the appendix at the end of this chapter. So we know from the chapter that in the first attempt, Marvin tries to raise $1 million by issuing 1 million shares. So let's look into these questions. What are the new information available here? Suppose that first Miriam decides that Marvin's shares are worth only 0.8 each. So share price is 0.80 dollars. So in the first attempt, the share price was $1 because we raised $1 million by issuing 1 million shares. Now the Mariam thinks that Marvin shares is worth $0.80 or 80 cents. So the first requirement is how many shares will Marwan need to sell to raise the additional 1 million. So to calculate the number of shares, uh, from this information we know that they of course need more than 1 million shares because they want to raise a $1 million and the one share is worth less than $1. Therefore, we need more than uh, 1 million shares. So how many more we can calculate it through a formula. So number of shares is equal to the required investment, required capital divided by share price. So we need 1 million and the share is worth only 0.8. So by calculating it we will get 1.25 million shares. Okay, so that's the first part. Second part, what fraction of the firm Mariam Managers owns after the investment? Okay, so we have the first round in which we have number of shares which is 1 million, and then we have this second round in which we have number of shares or 1.25. The total number of shares are 2.25. So calculate their shares, we have to divide it 1 with 2.25 and 1.25 with 2.25. So by calculating this, we will get around 55.56% shares, and this will be roughly around 44.44%. Question number 13. In April 2019, Van Dyck Exponents offered 100 shares for sale in an IPO. Half of the shares were sold by the company and the other half by the existing shareholders. So 100 shares offered in an IPO. Company is selling their 50 shares and also the shareholders are selling their 50 shares, each of whom sold exactly half of their existing holdings. The offering price to the public was 50, and the underwriters received a spread of 7%. The issue was heavily oversubscribed, and on the first day of trading, the stock price rose to 160. So, requirement number one, what was the proceeds of the issue to the company and to the shareholders? So the company issued 50 shares, each has a price of 50, right? But we have to pay some underwriter spread on it, so we will deduct this underwriter spread 0.07%. It will be same for both. So if we multiply these, then we will get 2325. So these uh, will be proceeds from the issue. Let's check the part number 2. How much commission did the underwriters received? So underwriters received 7% commissions. So in total, to calculate the commission, we can see that in total 100 shares were offered to the public. Each share was priced 50 and the underwriter commission was 7%. So by solving these numbers, we can get the commission, which will be 350, half of which was paid by the shareholders and half by the company. So this is our part 2. Then we have part C, how much money was left on the table. So money left on the table is actually the money is actually the underpricing, or the money which uh, company had left on the table for those investors who have bought the shares in an IPO. So if we see from the questions, we know that the company offered the share at 50 to the general public, and on the first day its price rose to 160. So the difference between these two is actually the money left on the table. So money left on the table will be 160 minus 50, and there are total 100 shares. So this will be money left on the table for 1 shares. If we want to calculate it for a total 100 shares, then we have to multiply it with 100. So in total it will be 11,000. Part D. So this was part C. Now let's calculate the part D. What was the cost of underpricing to the selling shareholders? So all the commissions and all the money left on the table is actually the cost of underpricing. So underpricing actually is like the real price of this stock was 160, on which it traded on the first day in the stock exchange. So market evaluated it at 160, but the company did not receive the 160. So what the company received is $50, and they paid 7% commission on these $50. So the each share gave around 46.5. Okay, so what is underpricing? So underpricing will be 160 minus 46.5. So this will be $113.5 per share. If we want to calculate it for 50 shares, right? Because they are asking underpricing for the shareholders. So shareholders sold only 50 shares, then it will be 5,675. So this is the cost of underpricing to the shareholders, and the cost of underpricing to the company will be the same because company have sold the same number of shares and at the same price.
Question number 15, it's about underpricing. So, having heard about IPO underpricing, I put in an order to my broker for 1000 shares of every IPO he can get for me. After 3 months, my investment record is as follows. So, the broker participated in 4 different IPOs. IPO A, he got 500 shares, each share priced at $10, and initial returns were 7%. Then similarly B, C, and D. So let's come to the requirements. What is the average underpricing in dollars uh, of this sample IPO? Sample of IPO. So to see the underpricing, we know that the initial returns are actually the underpricing. So the company sold the stock in $10, and on the first day of its trading, the stock rose about 7%. So the underpricing is about 7%. Are the 7% left on the table for the investors, right? So we have to calculate this underpricing in dollars. It's very simple. What we can do is we multiply the share price with the initial return, 7%. So it will give us the underpricing in dollars. Similarly, for all these 4 options, I will use the Microsoft Excel to calculate this. Hope it's visible. So we have 4 IPOs, A, B, C, and D. So these are IPOs. Then we have shares allocated in each IPO, which is 500, then 200, then 1000, then 0. And thirdly, we have price per share, which is 10, then 20, then we have 8, then we have 12. Then we have initial returns. Okay, these are 7%, then we have 12%, then we have minus 2%, then we have 23%. So to calculate the dollar under pricing, we will just take the share price and multiply it with the returns, and we will just drag it and all the underpricing will be calculated. Now our requirement is average underpricing. To calculate the average, we will add up all of these A plus B plus C plus D and divide it with the 4. So, or we can just write the average formula here, and right here we have $1.42. So this is the average underpricing from all these IPOs. So this is our first requirement. Let's get back to our second requirement. What is the average initial returns on a portfolio of shares purchased from 4 IPOs that I bid on? When calculating these average initial returns, remember to weight by the amount of money invested in each share. So next we have to calculate the portfolio returns. So to calculate portfolio returns, we will write a formula which is return on portfolio is equal to weight of stock A multiplied by return on stock A plus weight of stock B multiplied return on stock B plus weight of stock C multiplied return on stock C plus weight of IPO D multiplied by return on D. So RA, this is RA, this is RB, this is RC, so and this is RD. So we have returns. Now we have to calculate the weights. So to calculate the weights, we have to see how much we have invested uh, in each IPO. So these are our investment. So our investment in the first IPO was 500. We have bought 500 shares, and for each year we paid 10. So if we multiply it, we have invested total of how much? 5,000. In the second IPO B, we put 4,000, and in the third IPO C, we invested 8,000. In the D IPO, we didn't get any shares, so we uh, no, we didn't invested anything. So then we have to total it. Total it, we will use the sum functions. We'll just add up all of these. So now we can calculate weights. So what are the weights? Weights are actually the investment in portfolio A divided by total, right? Similarly, investment in B divided by total, and investment in C divided by total. So we will add up all these weights. They all should sum up to 1. So that's it. So now we have WA, WB, WC, WD, which is of course it's 0, so it will be 0. And then we have returns, all these returns. So what we can do is multiply all these return multiply with, or we can say we multiply weight with the return. So here is our weight and here are our returns. So multiply all. So let's go back to our formula. So we have multiplied all these weights with the corresponding returns. Now the last thing left is just add all of these values. So we will take the help of this and we will just use the sum function. Okay, so these are our returns 0.0394. If we want to write it in percentage, it will be 3.94%. So here 3.94%. So this is our part. This is our part B. So what about the part C? You have just encountered the problem of winner curse, true or false? Yes, true. Why? Because we got uh, like almost half of our investment in the C IPO. We got 1,000 shares in the C IPO, around $8,000 invested in C IPO, and this C IPO was actually overpriced. We couldn't get any initial returns. The initial returns were negative. So the IPO, we got the maximum shares. We were not lucky to get those shares. So we got those shares. In that case, we are lucky to get those shares, but we were unlucky because those shares were overpriced. And when they start trading in the market, the market corrected it, and their prices become lower as compared to the price on which we bought this. So the maximum returns were available to the DIPO, in which we got nothing. So we got uh, no shares in the IPO, which gives maximum returns, and we got maximum shares in the IPO, which gave negative return. So of course there is a winner curse. Question number 16. So the Fishwick enterprise has 200,000 shares outstanding, half of which are owned by Jenny and half by her cousin. The two cousins have decided to sell 1,000 shares in an IPO. Half of these shares would be issued by company to raise the new cash, and half would be shares that are currently held by Jenny. Suppose that the shares are sold at an issue price of $50 but rise to 80 at the end of the first trading day. Suppose also that the investor would have been prepared to buy the issue at 80. What percentage of company will Jennifer own after the issue? So we know that there were 2,000 shares before, right? So let's take the help of Excel. That will be better for calculations. So let's make a uh, few columns. So first we have shareholders. So who are the shareholders? First we have Jenny, then we have cousin, then we have some new investors. Okay. So then we have their share holdings. So Jenny, before the issuance of new shares, there were uh, 2000 shares. So half of which belong to Jenny and half to the cousin. So now in the new situations, what happened? The company had issued uh, new shares. Company sold 100,000 shares, half of which are new and half were sold by the Jenny. So Jenny had a 100,000 shares before, and from these 100,000 shares, she sold 50,000 shares. Now Jenny had 50,000 shares, and cousin has 100,000 shares, and new investor also had 100,000 shares. So let's make the total as we did before to calculate the percentage shareholdings. So there are total 250,000 shares, then we can calculate the percentage holding our shares. That will be the Jenny number of shares held by Jenny divided by total number of shares. So this will be 20%. Then we have this 100,000 divided by 250. 40%, and the same will be for the new investors. So these are the percentage holdings as required in the part A. So let's check the part B. What will her holding be worth at the end of the first day trading? So we have to calculate the Jenny's worth at the end of first day. So to calculate the Jenny's worth, we know the Jenny has some stocks. Jenny's stock. Jenny had 50,000 shares, and each shares will be selling at 80, because at the end of the first trading day, the shares will be a price 80. So what will be total? 50,000 multiplied by 80. So that will be 4 million. Then Jenny has some cash which she got from the sale of the stocks. So she sold 50,000 shares, and each share's price at 50. So how much she got from this sale is 2.5 million. So what is her total wealth? So we can just add these two numbers, and that will be her total wealth at the end of the first trading day. Moving on, let's see the part C. Suppose the issue had been priced at 80. How many shares would the company have needed to sell to raise the same gross proceed from the IPO? So first we need to see how much money the company actually gathered by selling the shares. So cash received from sale of shares. Uh, so the company sold 550,000 shares at the price of 50. So how much cash they gathered is 50,000, 2.5 million. So now we want to know um, what if the share price was 80, the company has sold the shares at 80, then how much money we would need to get these shares. So to calculate this amount, shares needed to sell, that will be, so we need 2.5 million. So we will divide it with the share price, and this will give us the new number of shares we will need, right? So let's use this divided by 80. So the company needed to sell 31,250 new shares to gather the same amount, which is 2.5 million. So that is our part C. Moving on, what in this case would be Jennifer's wealth? Assume Jennifer also need to sell her shares to raise the same gross proceeds from the IPO. So we need to calculate the Jennifer's wealth again. C part, Jenny wealth. So it's actually the D part. So this is C part. Jenny's wealth. So how many shares Jenny have? Jenny actually Jenny had uh, one 100,000 shares. Now the Jenny will sell only 31,250 shares. So what uh, Jenny's remaining shares will be 68,750. Okay, so shares value will be 68,750, and each share will be priced at 80. Right. So calculating these, we have 68,750 multiplied with the 80. We will have 5.5 million. Cash from sale of shares. So Jenny sold 31,250 shares, and each shares were sold at 80. So by calculating these numbers, we'll have 2.5 million. So total wealth will be sum of these two. So this will be 8 million. Now, what is the cost of underpricing to the Jennifer in dollars? So to calculate the cost of underpricing, we need a small formula. Actually, the cost of underpricing is um, share price, if we want to write it. So share price at the end of first day minus price at which company offered shares. So this will give us under pricing for one shares. So to calculate underpricing for 50,000 shares, we need to multiply this amount with 50,000. So the share price at the end of the first day will be 80, and the shares were offered at a price of 50. This will be underpricing of one shares, and if we multiply it with the total number of shares which Jenny sold, then we can calculate the total underpricing. So this will be $1.5 million. Question number 18. Spike Equino is the CEO of private medical equipment company that is proposing to sell 100,000 shares of its stock in an open auction. Suppose the company receives the bid in the following table. So these are the tables in which the company have received the bids. It clearly visible from this table that the issue was oversubscribed because we have more bids than the number of shares offered. So what will be the company's total receipts from the sale if the auction is discriminatory? So in discriminatory auctions we charge the price as quoted or as bidded by the investors. So we'll sell 20,000 shares at 80, 10,000 78, 15,000 at 73, then 25 at 70. So we need a total of 100,000 shares. So to calculate, to complete a 1,000 shares, we need the first 20,000 shares. Then we will use the next 10,000 shares. Then we will use the 15,000 shares. Then we will use the 25,000 shares. Then we will use 10,000 shares. Then we will have 8,000 shares. Then we will need 12,000 shares. So from these 14,000 shares, we will need only 12,000 shares. So this will be our 100,000. So these shares will remain unsold plus 2,000 from here. So if we do the discriminatory auctions, so what we want to calculate is the total receipts. So we will keep multiplying it until we reach the total amount. So for the first 20,000 multiplied with 80. Then for the second 10,000 multiplied with 78. For the third 15,000 multiplied with 73. Then the fourth 25,000 multiplied with 70. And then sixth will be 10,000 multiplied with 69, and the next is 8,000 multiplied with 67, and then lastly we have 12,000 shares at the price of 66. So to sum up how much total receipts will be, we will just add all these numbers, and these will be the total receipts, right? 7.2 million. So this is part A. In the part B, what if the uniform price? In the uniform price, we charge the same price, and that price will be from this lot. So all the shares will be charged the same price, which will be 66. So uniform price from uniform price, it will be 100,000 shares at a price of 66. It will be 6.6 million. In practice, would investors tend to be more cautious in their bidding in a discriminatory or uniform price auction? Generally, in the discriminatory auctions, investors tend to bid more conservatively. They are more cautious because there is a risk of winner's curse, and they can easily overpay if they bid higher. They will be allocated shares because their bids are too high, but uh, they might be buying shares at a premium. In the uniform auctions, this winner curse uh, eliminated because the price, uh, the discriminatory prices will not be charged, and you will be charged the price at which the total all the shares will be sold, and that price will be charged. Like in this examples, the price charge will be 66, no matter if you have uh, bid it for 20,000 shares at a price of 20, but you will be charged 66. So there is a less chance of overpaying. So buy people bid more comfortably in the uniform auction pricing. Question number 22 is about the right issue. So in case of right issue, company gives the right to the shareholders. They can buy shares usually at a discounted price. So if the shareholder is not interested in the right issue, then that issue can be offered to someone else. So the first right is the right of the existing shareholders, and usually the existing shareholders exercise this right because the share is being offered at a discounted price. So, question number 22, Associated Beverages is planning to market alcohol free beer. To finance the venture, it proposes to make the right issue at $10 of one new share for each two shares held. So they are offering one share to the shareholders who is currently holding two shares at a price of $10. The company currently has outstanding 100,000 shares priced at 40. So current price is 40, but the new shares, the right issues is being offered at $10. So there is no way that the existing shareholders will refuse this issue because it's being offered at a huge discount. Assuming that the new money is invested to earn a fair return, give value for the following. So the requirement number one is number of new shares. So number of new shares. So to calculate number of new shares, we will do like we use the existing shares which are 100,000, and one new shares will be issued to those who have two shares. So every two shares will be given one shares. So the new number of shares will be 50,000. Amount of the new investment B. So amount of investment will be number of new shares multiplied with the share price. Issue share price. So number of new shares are 50,000 and they are being offered at $10 each. So this will become 500,000. This is the new investment. Part C, total value of the company after issue. So total value will be old value plus new issue. So previously company had 100,000 shares, each price at 40, and now they have new shares which are 50,000 and they collected $10 each. So if you math all these, this will be 4 million and this will be 0.5 million or 500,000. In total it will be $4.5 million. Then the part D, total number of shares after the issue. So total shares will be old shares plus new shares. So old shares are 100,000 and new shares are 50,000. So in total there are 150,000 shares. Then we have E, stock price after the issue. So stock price is equal to value of firm divided by number of shares. So from part C, we know that the value of the firm is equal to 4.5 million. And the total number of shares from part D is 150,000. So the share price is $30. Question number 23. It's about the right issue. In 2012, the Pandora Box Company made a right issue at $5 a share of one new shares for every four share held. So we are giving one new share for every four share holds. Before the issue, there were 10 million shares outstanding and the share price was $6. So requirement number one. What was the total amount of new money raised? So to calculate the new money raised, we first need the number of new shares that will be issued. So new shares. For this purpose, we will take the number of old shares which are 10 million, right? And divide it with 4 because we are issuing one new shares for every 4 shares held by an individual. So the number of new shares will be 2.5 million, right? So our question is the total amount of new money raised. So then now we can calculate the new money. So this will be the new shares multiplied by the right issue price, that is $5. Okay, so by multiplying it, we will have 12.5 million dollars. That's it. Coming to the part B, the right issue gave the shareholders the opportunity to buy one new shares for less than the market price. What was the value of this opportunity? So the share price is currently the share price is $6, right? And the shareholders have been given an option to buy the right at $5. So the question is asking what is the value of this discount or how much benefit the shareholders will get if there is any. So the share to calculate the share value or right value or opportunity value will be equal to the share price or current share price minus the right issue price and then we will divide it with the new number of shares. So new number of shares will be n, the old shares plus the one new shares given to the shareholders. So the current share price is $6 given right here, minus the old share price is $5, right? The number of old share n is 4 plus the new one share have been given. So by calculating all this, this will be 1 over 5, which will be $0.20. So this is the value of uh, right issue or this opportunity. So this is the discount they are getting. Then the part C, what was the prospective stock price after the issue? So to calculate the stock price, we need the same information, right? We have seen in the previous question. So stock price is equal to market value or total value, whatever you want to call it. We let's say the total value and divide it with the total number of shares. So to calculate the total value, we need the old shares, which were 10 million, and multiply them with the old share price, which was 6, plus we need the new number of shares, which were 2.5 million, and multiply them with the right issue value, that was $5, and divide it with the total number of shares, which are 10 million plus 2.5 million. So by solving all this, you can reach to the share stock price, which will be 5.80. So you can reconcile the answer in the previous part. Opportunity value is 0.20 and the stock price will fall to 5.80 after the new issue. But this new issue will not impact your value. For example, if you had 4 shares, each shares will be valued $6, so it will become 24, right? Now, what you have done is you bought a one new share at a price of 5. So by adding this, you have $29 worth in the company. By seeing the new share price, uh, now you have a 5 shares, right? And the share price is 5.80. It should also come 29. So if you are accepting the right issue, then your value or your worth will not change. But if you reject the right issue, then your value will decrease by $0.20, right? Because you haven't bought the share at $5, and after the issue, the price of all the shares will fall to 5.80, so you have lost 0.20. So that's why shareholders never reject this right issue. They always accept this right issue offer. So let's get back to our questions. Part D. How far could the total value of the company fall before the shareholders would be unwilling to take up their rights? So if the shareholders are not willing to buy the shares at $5, then the market will think that share might be the right issue might not be the worth. Then the share price, which is currently at 6, is expected to fall to the price of 5, which is the offer price of the share. So the company is not issuing the new shares because nobody is willing to buy. Everyone is unwilling, so no new shares will be issued. So the company's total value will be the 10 million old shares, and the price will drop to $5. So the total wealth of the company, total value of the company will be 5 million. Okay. Question number 24, it's linked with the previous question. You can first you have to watch the previous question. It will be available in the playlist. So question number 23, then you can come to the question number 24. So because it's on the same pattern, if you can solve the question number 23, then you can also solve the question number 24. Plus, it uses some of the data from the question number 23. So problem 23 contains details of the right offering by the Pandora box. Suppose that the company had decided to issue new stock at $4. In the question number 23, the new stock was issued at $5. Now the company is issuing the stock at $4. How many new shares would it have to sell to raise the same sum of money? So in the previous example, in the previous problem, the company has raised around 12.5 million of money. So this question asks how many shares will be issued if we are selling the shares at 4. So of course, we have to issue more shares as compared to the previous example uh, to collect that 12.5 million. Uh, to calculate that amount, we know that the number of shares will be equal to the amount collected divided by share price. So the collected amount is 12.5 million. It can be seen from the question number 23. So in these questions, we have the 10 million shares. We are giving one new share to every 4 share held. So that's how we will have a total of 2.5 million new shares, and each shares will be issued at $5. So the total amount collected will be 12.5 million. So the 12.5 million. And now the share price is 4. Therefore, by calculating this amount, we will have 3 million or 3.125 million shares. So these number of shares will have to be issued at $4 to collect the 12.5 million of money. So that is our the first requirement, like how many shares would it have needed to sell to raise the same sum of money. Then recalculate the answers to part B to part D in problem 23. So in problem 23, the B part says the right issue gives the shareholders the opportunity to buy one new shares for less than the market price. What was the value of this opportunity? So the value of opportunity is equal to right price, the share price or current share price minus the right issue price. This will give us the opportunity of one shares. So we will divide it with the total number of shares, like n is the old share plus 1 the new number of shares allotted, right? So what is the n? So in the previous example, the one new share was allocated to every one. One new shares was allocated to every four shares held. So now we are actually offering more shares as compared to the previous example. In the previous example, uh, we were issuing 2.5 million shares. Now we have to issue 3.125 million. So if we issue one share to every four shares, then we can only issue 2.5 shares, 2.5 million shares. Therefore, we have to lower our base. We have to go lower than the four shareholders. It might be uh, for every three shares held, or for every 3 point share held, we will give one new shares. So to calculate this n, uh, we will use the old number of shares, which were 10 million, and we will divide it with the new shares we want to issue, that is 3.125 million. So by dividing this, we will get 3.2. So one new shares will be given to every 3.2 shares held. So by putting these figures into this equation, the share price is 6 minus the right price is 4 divided by 3.2 value of n plus 1. So by solving all of these, you will get 0.48. So this is the opportunity value for for the right issue. Part C. What was the prospective stock price after the issue? So the stock price. Stock price is total value of firm divided by number of shares. So to calculate the total value, we know that previously we had around 10 million shares. Each shares was valued at $6. Now we are issuing new shares, which are 3.125 million, and each share has a price of $4. By multiplying these two, we will get 12.5 million, the new money raised, right? Divided by, we have So let me write this in the million. 12.50 million. Divide it with the number of shares. So the previously the number of shares were 10 million plus the new number of shares are 3.125 million. By solving all of these, you will get the new share price, which is $5.52. Another thing it requires is how far could the total value of company fall before the shareholders would be unwilling to take the new issue. So the part D is how far it could fall. So there are the total number of shares are 10 million and the new issue is priced at 4, then the price will be 40 million if nobody is willing to buy this share. One more point given in the question 24 is show that the shareholders are just as well off if the company issue the shares at $4 rather than $5. So suppose if you had a 3.2 shares in a company and each share price at $6, by multiplying it your wealth will be 19.2. Now you are given one more share at 4, so you have 4 more dollars, right? So your total wealth is 23.20. In a new situation, now you have 4.2 shares, so 3.2 old and plus 1, and the share price is now 5.52. So by multiplying it, you will get the same number, right? So there is no change in your wealth, even if the company issue a share at 4 or 5 or whatever, your wealth remain the same until you participate in the right issue. Question number 25. Suppose that instead of having a rights issue of new stock at a $4 as given in the previous problem number 24, Pandora decided to make a general cash offer at $4. Would existing shareholders still be just as well off? Explain. So to solve this problem, you have to solve the problem number 24 first. Therefore, go watch the problem 24 video in the playlist. You can find its link in the description. So, what is the difference between these two things? So, one is the right issue at $4, right? So, this issue is specifically for the existing shareholders. General public or the new investors, they cannot buy these right issues. This is exclusive right for the existing shareholders. If they refuse to buy the share in the right issue, then the company can offer to the general public or other parties. What is this general cash offer? General cash offer is for everyone, for the general public. Um, so we know from the previous examples that if whenever we issue shares at a discount, the share price drops. So the share price currently is 20. The current share price is 6 as provided in the example number 23. So if you issue the new shares at $4, the share price will go down and it will become 5.52. Therefore, what will happen to the existing shareholders? Will the existing shareholders still be just as well off? No, their share is currently worth $6, and if you offer a general cash offer at $4 and the general public will buy these shares at $4, then the share price will drop to 5.52. So how much loss they would have? So loss to shareholder, the current share price minus the new share price. So by subtracting this amount, we will have 0.48. So how many new shares, how many old shares are there? There are currently 10 million shares, right? And we multiply it with 0.48. So this will become $4.8 million. So this will be the total loss to the existing shareholders. Of course, this loss is a gain to the new shareholders. New shareholders will buy the share at 4, and after buying these shares, the share price uh, they will get is 5.52. So the profit, or you can use the word gain, gain to new shareholders is the new share price 5.52 minus the price they have paid for the shares. So for each shares they will get 1.52 dollars gain, an instant gain, and they have bought the new shares, 3.12 million new shares, and the gain on each share is 1.52. By multiplying this amount, you will get almost the similar amount to this, $4.8 million. So the new shareholders will profit on the expense of old shareholders. That's why whenever the new shares are issued at a discount, they are always offered to the existing shareholders. They are given a privilege rights. Uh, so if they refuse, then you can offer to the other shareholders. Question number 26. It's about the private placement. You need to choose between making a public offer, offering and arranging a private placement. In each case, the issue involves 10 million face value of 10-year debt. You have the following data for each. A public issue, the interest rate on the debt would be 8.5% and the debt would be issued at a face value. The underwriting spread would be 1.5% and other expenses would be 80,000. Private placement interest rate would be 9%, but the total issuing expense would be only 30,000. So what is different in the proceed to the company net of expenses? So to the proceed to the company are actually the 10 million, but we have to pay some expenses. So we will deduct all the expenses uh, which we have to pay at the time of issue, and the remaining amount will be the net proceed. So let's start part A. For the public issue, the net proceeds will be 10 million, and then we have to uh, deduct the underwriter spreads 1.5%. Then we will deduct some other expenses which are 80,000. So after solving all of this, we will have $9.7 million. For the private placement, now we have 10 million and we have only 30,000 as issuing expenses. There is no underwriting spread. So this will be 9.9 million, 9.97 million. Part B. What is the difference in the proceed to the company net of, oh sorry, other things being equal, which is a better deal? So if we ignore the interest expenses, then it seems that private placement is a better deal because it's providing us more money as compared to the public issue. So if we include the taxes, then we can see that the public issue has lower taxes, it's only 8.5%, while the private issue has the higher interest, 9%. So there is a difference of interest expenses in both cases. So we will compare these two on the basis of it. So for expenses, we know that we have to pay these expenses every year. So for example, for a public issue or for a private issue, we will, for a private issue, for example, if we are raising $100 loan, Then each year for the next 10 years, we have to pay 9% interest, which is $9. So we will pay $9, then $9, then $9 till the end of the period. So if we, what will be the total cost? We have to calculate the present value of all of these future cash flows. So uh, there are two ways. We can calculate the present value of all of the future interest payments for a public issue at 8.5%, and then we can calculate the interest payment for a private issue at a 9%. Uh, and then we can deduct those interest payments from these above proceeds. Then we will see which options will provide a higher interest proceeds. Another option is we know that the 8 point, the one that public issue has interest of 8.5%, while the private placement has 9%. So the difference is 0.5%. So we can only take the difference, like 0.5% here, 0.5% here, till the 10th year. We can calculate its present value and we see if what is its amount, then we compare it with the difference between these two values. So if we see the nature of this cash flow, this cash flow is actually an annuity because there are uh, equal amounts at each interval, and we know the time period, it's 10 years, so fixed time period and the equal amounts at each time period, and the distance between the two intervals is also the same, like 1 year. Then we can use the annuity formula present to calculate the present value. So the present, there are different annuity formulas. You can use anyone. All of these are different variations of this same formula. So I am using this present value of annuity formula. So uh, the cash flows or the payment or the fixed payment we will be giving each year's. Then we multiply it 1 over R, the interest rate, the opportunity cost. Then we have minus 1 over R into 1 plus R par T. So it's a 10-year bond. So T will be 10, and the cash flow. So the cash flow. So we know that the difference is 0.5%. We will multiply it with the 10 million, and this will give us the annual payments RSC, which is 50,000. So here we have 50,000. Then the R will be 0.085 minus 1 over 0.085 into 1 plus 0.085 for 10 closing brackets. By solving for this, we will have 50,000 into 11.76 minus 5.20. So by further solving, we'll get 328,000. So this is the extra interest we will be paying if we take the private placement, because the private placement has 9% interest and the public placement has 8.5% interest. So we have calculated this, uh, the present value of extra interest, the 0.5%. So if we take the private placement, we have to pay an extra 0.5% interest, which will be 3,28,000 in total. So what is our total savings if we go for a public placement? So if we subtract both of these amounts, we know that we are getting 200,000 more money if we go for a private placement. But the private placement will increase our expenses by 328,000. So we have to pay actually 128,000 more as compared to the public issue if we choose for a private placement. Therefore, from these information, we can conclude that a public issue is a better choice under the given situation, because it will give you or save more money in a longer run. While the private placement seems more attractive if we ignore the interest expenses. So C part, what other factors beyond the interest rate and issue cost would you wish to consider before deciding between the two factors? So in a public issue, the company actually has less flexibility, because it depends on the general public whether they are bidding for the issue or not, what prices they want, or how many shares they are interested in. While in the private placement, that can be negotiated in a better way. It can be tailored, right, as per the needs of the firm. Uh, so the firm and the private parties or the banks, they can negotiate a better deal which suits both the parties, and it will be quick. While the public issue, it cannot be tailored enough to accommodate both the firm and the general public. Therefore, sometimes it's better to go for a private placement, even though it's a little bit expensive as compared to the public issue.